Trading isn't as simple as deciding whether to buy or sell. When you buy or sell cryptocurrencies, stocks, foreign exchange, or any other type of financial asset, you'll come across different types of orders. From fill or kill orders to stop limits, market orders are one of the easiest and are often used by beginners. Let's look at what a market order is and how it works. Market order definition. A market order is an order to buy or sell something right away at the best price. It needs to be filled with liquidity, which means that it is carried out based on the limit orders that have already been placed on the order book. Setting a market order is your best bet if you want to buy or sell right away at the market price. For instance, the price of BNB might be going up quickly, and you might want to buy it as soon as possible. You don't mind paying the market price as long as you can buy BNB right away. In this case, you would put in a market order on the exchange you choose. How to place a market order. Market orders are filled right away at the current market price, while limit orders are put on the order book. In a trade, there are always two sides, the person who gives and the person who gets. When you put in a market order, you accept the price that someone else has set. For example, an exchange will match a market order to buy with the lowest ask price on the order book. A sell market order, on the other hand, will be matched with the price with the most bids on the order book. As was already said, for market orders to work, an exchange must have enough money on the order book to meet the demand right away. Since a market order takes liquidity away from the exchange, you'll have to pay more fees if you're a market taker. The difference between maker fees and taker fees is clear from Binance's fee schedule. The exchange looks at the order book after you place your order. This ledger has limit orders to buy or sell an asset for a certain amount at a certain price. In this case, your market order to buy 1 BNB at the market price, also called the spot price, will be matched with the lowest sell limit order on the order book. But say you want to buy 500 BNB at the market price right now. Your whole market buy order can't be filled by the cheapest sell limit order that's available. Your market order's remaining volume will be automatically matched with the next best sell limit orders, moving up the order book until it is completely filled. This is called slippage, and it's why as a market taker you pay higher prices and fees, or get a lower price. Market order versus limit order. In short, limit orders are requests to buy or sell a certain amount of a financial asset at a set price or higher. You can also choose whether the exchange can only partially fill your limit order or if it must be completely filled. In the second case, the exchange won't carry out your order at all if it can't completely fill it. Market orders can only be filled with limit orders that are already in place. When trading or investing, not everyone wants to take the price that is available on the market. A limit order is a good way to get around this. You can plan your trades in advance without having to be at your desk trading if you use limit orders. Aside from these basic differences, market orders and limit orders are best for different trading activities and goals. Most of the time, limit orders are better for when the price of an asset changes a lot. When you put in a market order in a market that is very volatile, you might get results you didn't expect. Between when you place the order and when it is carried out, the price could change. Arbitrageurs can make or lose money based on how much these small differences matter. With a limit order, you'll get the price you want or a better one. 2. When an asset is hard to sell. In this case, slippage could happen if you use a market order. This happens when there aren't many market makers on the order book and your order can't be easily filled at the market price. You'll end up with a lower average price to sell or a higher average price to buy than you thought. On the other hand, a limit order will not be fully filled if the price slips past your limit. 3. If you have a plan already. Limit orders can be placed ahead of time and don't need your help to start being filled. This means that even when you're not actively trading, your strategies can still be put into action. With a market order, you can't do the same thing. When should a market order be used? As we've seen, market orders are useful when getting your order filled is more important than getting a specific price. This means you should only use market orders if you are willing to pay a higher cost caused by the slippage. In other words, market orders can help you get things done quickly. Sometimes, your stop limit order might have been passed over, and you might need to buy or sell as soon as possible. So, market orders are helpful when you need to trade right away or get yourself out of trouble. But if you're not a complete beginner to crypto and want to buy some altcoins with your Bitcoin, don't use a market order because you might pay more than you need to. In this case, it's probably best to use a limit order. When trading highly liquid assets with a narrow bid-ask spread, a market order will get you a price close to or at the expected spot price. Slippage is much more likely to happen with assets that have a wider spread. After that, a confirmation message will show up on your screen, and your market order will be carried out. Advantages of using a market order. There are three main reasons to use a market order, which depend on the situation. 1. It's easy to put in a market order. A market order is a pretty safe way to trade a coin with a big market cap and a lot of buyers and sellers, like Bitcoin or ETH. 2. You can buy or sell the full amount of an asset you want. With a market order, you can almost always be sure you'll be able to close all your positions or open one as soon as possible. You can trade right away. You might be in a hurry to make a trade, like right before the market closes. Almost always, your market order will be the fastest way to do this. Not so good things about using a market order. Even though a market order is fast, which is its main strength, it gives you very little control. The main things that are bad about it are: 1. Low volume assets can give you a lot of slippage. You might end up paying a lot more or getting a lot less than you planned. If you don't have enough orders on the order book, you will move up or down the list of orders. 2. You can't plan out your trades in advance. You can't always be ready to trade at your screen. You won't be able to place a market order if the market moves against your trading plan while you're asleep or not around. If not, you can plan ahead with a limit order or a stop limit order. Final thought. A market order is the most straightforward way to buy or sell financial assets. They are the best way to get into or out of a market quickly. But this means you don't have as much control over the order as you would with other types. Your best bet is to think about the situation you're in and figure out if a market order or something else is best. Thank you for watching.